Hi, everybody. This is Jim Wessel. I'm the Director of Strategic Relationships at Eide Bailly. I serve as a resource for professional services firms, primarily accounting firms, to help in situations where your firm does not have a specific service or the issue is outside of your experience or comfort level. And I help to find the right resource within Eide Bailly to assist with those situations and guide your client and your firm along that solution process. So please reach out to me if you have a situation. It can be an international tax issue, an energy efficiency issue, or any other issue that you run across that's outside of your scope. Today, we have two outstanding experts and presenters today. First off is Mark Rogers, who is an architect by training. He's also a principal at Eide Bailly and leads our energy incentive program. We also have Shannon Smith, who is a CPA by training and leads our international tax services group. And with that, I will turn it over to Mark.
All right, thanks, Jim, and thanks everyone for hopping on. Happy to be on. We have an intimate group today. This is a roundtable, not a webinar, so to speak. And so I encourage, as we go through, me, Shannon, and Joe and Neil go through, if you have questions, you could raise your hand, you can put it in the chat. We'll pause every once in a while too to take some questions. So it's just some opening remarks, and that was kind of the second bullet there. First bullet, you got a QR code right there. You can go ahead and put your phone up to it. We're going to go through probably $1.7 trillion of stuff today. It's going to be hard to package it. So why don't you go ahead, scan that in. That'll have all the documents and links and resources that you can reference back to later. Then I say follow along the placement. There are some handouts. These handouts, some are for exempt organizations, if your clients are in that industry. Some are for-profit. Some are a little bit more defined. But check out the handouts, and if that's not easily available, you can't find it, just ask my where that's at, but it should be in the docket. You can follow on the placement as well, and we'll have the deck. Another point, there's my email. I would say if you have any questions, reach out to Jim first and foremost, but copy me. That's fine as it relates to energy, and Shannon as it relates to international. If I don't know the answer, the royal we here at Eide Bailly, we have a team of 20 plus energy incentive consultants. So that team just happens to work for a 100-year-old accounting firm, but really we're niched as professional engineers, CPAs, and attorneys doing just this. And yes, professional engineers, we're licensed in all 50 states, which is very weird for an accounting firm, but something that, we love partnering with other accounting firms to offer these energy services to their clients. So opening remarks, there you go. Let's get into the meat of it. You see us on the screen, you see our pictures. There's me, I'm out of Chicago, and there's a story there, but I've been here for quite a bit, and Shannon's out of Boulder. But me and Shannon, besides working in our home offices, we're constantly on a plane wherever we're needed nationally. And Joe O'Neill, his picture's not up here, but he's going to be doing some color commentating. He's very big in the energy space as I go through. All right, fixed asset services and energy incentives. I'll start pretty high level on fixed asset services, and then we'll narrow down to energy because that's the rage right now. But when it comes to any fixed asset services, these are the two questions that you need to ask of your clients. Is your client in the mood for incentives? Starting in 2023 through 2032, this includes exempt orgs, and I'll get into how that is even possible. because yes, they don't pay tax, and we all know that. If the answer is yes, you move on to the next question. Does your client own, lease, or design buildings or building improvements? If the answer to those two questions is yes, yes, then there is something for them within recent tax legislation and not so recent tax legislation. So here's the fixed asset life cycle as it relates to incentives. So what you're looking at here is 0, 5, 15, 30. Those are years. So when your clients build a building or purchase a building, they should be doing a cost segregation. And cost segregation has been around since time itself. It's basic blocking and tackling, and we'll talk a little bit about it, but it's accelerating your depreciation from a 39 or 27 and a half year bucket to a 5, 7, or 15-year bonus bucket. So it's a timing difference. You're getting your money faster on certain building components. Then there's energy incentives, and we're really going to dig in on this because this is where all the material dollars are going from the Inflation Reduction Act. And then, of course, repair studies. And as you get farther along and you start to refresh your building, qualified improvement property, that came out in the Tax Cut and Job Act of 17 and got enhanced in 2020 in the CARES Act. So hopefully QIP is becoming one of those basic blocking and tackling and depreciation game, like cost segregation. Renovations and expansions, you can start getting some meaty construction happening, start to get some partial dispositions along with the cost seg. And you can see as you go along and you got rehab or demo, all these things come back again. So this is the life cycle. Happy to talk about cost segregation and repairs and QIP, but fair warning, what our clients are requesting of us is what's going on with energy. It is the flavor of the month. So this is how we're explaining to our clients what's going on, because there's a lot of different players, and who gets what and who earns what is a big question. So I'm going to tell a little story, a fable, and these are the characters throughout. Leadership. This is pretty much the building owner. Healthcare, education, banks, real estate. If you're in this role, there's a lot of energy incentives available to you. Then the designer, which could be leadership's architect, engineer, and or contractor. They can make some money off this. And at the same time, serving their client, the horse, in getting a sustainable building. And then there's the energy incentive consultant, and this is where we come in. That's a collection of CPAs, engineers, and attorneys that bring it all together. So these are the characters. Let's get into it. Here's the challenge, and then I'm going to say the solution right away. And then we'll go into the plot, and that could get pretty boring in the weeds. If you want to space out that time, great. But I want to get at least the good stuff, the ending, out of the way. So here's the challenge. This is a true story. We got approached by a hospital in the winter of 22-23. This is, well, keep in mind the Inflation Reduction Act got enacted in August of 22. So they came, what's in it for me? They had a 40,000 square foot ER renovation in South Dakota. It needed many things, but the HVAC system is what came up as the challenge. And they were in between two different ones. A natural gas powered system, which is the norm, or a geothermal one. The hospital wanted to be energy efficient and sustainable as part of their mission from a leadership point of view. They just didn't have the money. The nice thing about geothermal and any renewables is over a 10-year spread, you might get your money back through utility bill savings, but the upfront cash would be nice. And so how did it all shake out? So we got involved. as the hawk. And we guided the building owner and the designer through the energy incentive program. And I'll get to what that program is when we get into the weeds. At the end of the day, the building owner, the hospital, leadership, they went with the geothermal. And they went with the geothermal because they're going to get a $1.2 million incentive. In this case, they were non-for-profit, this hospital. They're going to get direct pay. They're going to get a briefcase of cash. They're going to get a check from Treasury. It acts like a rebate. If this was a for-profit hospital, they would get a credit off their taxable income for this amount. So you can see the 1.2 covers the 800K, which is wonderful for the geothermal, and they pocketed $400,000. And we'll go into the weeds and how that's even possible. Obviously, it's more than 100% of when they set up, it's more than 100% than their investment. And they got their mission sustainable and green, and they do have that utility bill decrease that'll kind of pay for itself. For our architect, engineering, and general contractor clients, the Beavers, they get something too. And one does not take away from the other. They got a $200,000 deduction for their taxable income. Also, because it was an $800,000 upgrade, they got increase in their scope because they get 10% overhead and profit for design fees. So they got $80,000 more in designer fees, which leadership has no problem paying because that is also credible, and that money's going into them, wrapping into the $1.2 million incentive. And they got goodwill from a happy client. And of course, these designers, this type of work is right down Main Street for the research and development credit. You should just capture it all at the same time. Okay, that's the resolution. Now we're going to get into, that's the ending. We're going to get to how did we get there? And get some more of the technical jargon. So here's the setting of this fable, and that is the climate economy. And that is what we're all in as of January 1st of 2023. As CPAs and consultants, this is the setting for our clients. Back when Joe Manchin and Joe Biden shook hands and agreed on the Inflation Reduction Act, the CBO scored this at $570 billion of energy goodies will be handed out over a 10-year period. And that's what was voted on, was pushed along party line votes, and it's now the law of the land. There are about 24 incentives in this IRA. Many of them are uncapped, which means the more you ask, the more you get. And if our clients are going to ask for it, first they need to know they even exist. And I think that's where we come in as hawks, as CPAs, is to let them know these things are out here. You need to ask for them. You need to apply for them. It's a lot of money. Because it was uncapped, Credit Suisse came out with an article that said, we think a lot of people are going to ask more than 570 billion worth. We think it's closer to 1.7 trillion. So the point is, who knows? We'll find out in 10 years what the range, 570, 1.7 million. But it's up to us as hawks to be out there and advising and letting our clients know that this actually exists. It's not too good to be true, and it can change behaviors. So we talked a little bit about materiality. We got 10 years of this stuff. Material, trillions of dollars. Another thing just as important is it's available. If anyone has played in the credit and incentive game in the past, and I've done this for 20 years, there's certain credits that are retroactive in nature, or only last a year, or kind of get stuck in between pages of law. Now you can imagine us as accountants can plan for this in tax cash flow strategy, in funding strategy for our exempt orgs. We can now account for this. You imagine architects and engineers. They could plan for this in their design. The earlier, the better, knowing that these things are going to come back to their clients or come back to them. So the fact that we'd like to have it permanent, sure, but 10 years, that's a nice runway to get a lot done and capture a piece of that $1.7 trillion pie. And this isn't coming out of nowhere. The money's great. I think the money is what's finally tipping. But your clients and this country and the world as a whole has started gravitating towards sustainability and renewability when it makes sense financially, and finally now it does. But in 2015, you have the United Nations Sustainable Development Goals. There's no mistake that out of 17 goals, 9 of them have to do with buildings. So your clients who are building buildings, renovating buildings, remodeling buildings are probably thinking about these things. Sustainability reports. Some of the big boys are now have this saying purpose over profit, or you might have heard of conscious capitalism. And part of that is green building certifications that are coming out for their stakeholders and for their shareholders, these sustainability reports to show off and to brand themselves. So this is all a part of it. We won't get into that other than this slide. We're just going to get into the money part of it. And here's the money part of it. The nucleus here of this graph is a good takeaway slide. I think it's within the QR code, but you might want to take a picture. Well, it's part of the deck. So the Infrastructure Act got signed right away once Biden got sworn in, pretty much right away, offered many incentives. The CHIPS Act, you remember that one, the semiconductor, even more energy, but really the cherry or the meat is this Inflation Reduction Act. And you can see there's tons of code sections, depending on where you go. The ones in bold, 48, 179D, 30C, 45W. We'll talk about those because 90% of the time, those are coming up every time. Okay. So by now, you should realize that the Inflation Reduction Act is doing very little to reduce any inflation. It was a clever name. Essentially, what this bill is it's the largest energy bill in American history. It's 3 parts to break it down, and we'll go through all 3 parts. Renewables, energy efficiency, and decarbonization. And as we go through every part, we'll slow down and pause and see if there's any questions or you want to elaborate on anything. Also, a little bit about the setting. I was at an AIA event. She talked to 50,000 people. Robin, she runs almost 380 million square feet of government property. And, we talked a lot about the momentum of leading up. Now we have the money. And so with those 2 things together, that's really going to explode this green energy property kind of revolution. And hopefully $1.7 trillion is enough to do it. It's quite a bit of government spending. So the Energy Incentive Program, when I talk about bringing together, that's where the hawk, the CPA, the attorney, the professional engineer bring together thousands of pages of legislation and directives and guidance, and then construction documents, blueprints, specifications, and marry these 2 things together. That's what we do. And of the 24 incentives that are out there, hopefully we get 1 to hit, or 2 or 3 or 4. But that's the point of the program, is not leaving anything up in the cloud. And it's really a come together moment. I would say I have been on no less than 10 discovery calls, me and my team, a week since September of 2022. And the discovery and with building owners, leadership, sometimes with architects, sometimes with both. The discovery calls that go the best is if all 3 are on the phone at the same time to chart a plan of action. Otherwise, if one person's not on, then it's another phone call to bring in the architect, another phone call to bring in the building owner, another phone call to bring in the accountant, the consultant. So really a come together type of moment to make sure we're maximizing these incentives. Throughout, you're going to hear some stuff about base and bonus. So this is kind of a setup slide for that. And we'll get into a little bit more details, but there are bonuses. So Congress comes out with these laws and says, hey, you get this much money. And if you do this, this, and this thing, we'll give you even more money. They obviously want to incentivize certain practices, and that's the name of the game. There are bonuses for low-income communities, for energy communities, which there are maps for these things. You can find out if your clients' building projects are within there. If you pay prevailing wage, heck, even if you don't pay prevailing wage, there's safe harbors to allow you to get bonus if you don't pay prevailing wage. Again, a lot of rules. Registered apprentices kind of go along with prevailing wage. Meet domestic content requirements. That one is made in the US, and there's hurdles to jump through for that one. The environmental justice allocation, I put that on top just because there's deadlines for that one. The other ones, you kind of invest, you get that percentage. This environmental justice allocation, if your clients are doing solar or wind, then they might want to apply for this sooner than later. Applications just opened up October 19th, so a couple days ago. And there's a pool of money and there's a pool of capacity. And once that gets reached, no more. So talking about being a hawk and getting people together, we need to let our clients know, hey, if you're thinking about, or you've been drafting up, or you're getting quotes in solar and wind, let's come together and start talking about this environmental justice allocation. So this is the first one in this whole list that deadlines are starting to approach. I would say, yeah.
I was gonna say, Mark, I don't know if anybody by show of hands in this space works in affordable housing in general, but this is an absolute area of opportunity for folks that are working in the affordable housing space. Affordable housing, you know, it really kind of lives and dies by qualified basis. And for this specific area, Section 48 credits, while it does reduce basis, the payback, generally speaking, is favorable. So it's something that you still want to go after, but you really do need to get it up into that 40 or 50% range. Base credit in that space is generally going to be that 30%. And you've got the qualifiers past that. So this environmental justice allocation, now that it's opened up, we are helping quite a few clients of our own with applying for it. There is, you know, a limited amount of credit that is available. The way that they are ultimately doling it out is pretty unique. It's based on kilowatt hours rather than dollars. So now is the time to be going to your clients and making sure that they are aware of this environmental justice allocation. The other place where we see it, frankly, a lot is in governmental space, where companies, or excuse me, governmental could be a school system, are adding solar or wind. Mostly it's solar. And from there, if it's in a low-income community, we believe there's a position to file for that additional 10 or 20%. So really cool area that just opened up, kind of similar in to Section 48C, in that we don't really know how the sausage is made here, so to speak. But we do know we want to get in earlier than later.
So you can see there's a lot to digest. And if you're not having conversations yet about this, I'd say I've been giving this presentation, and in January, February, say we have a long runway. These are 23 items. The runway is getting shorter and shorter.
Time to take off, right? You know,
it really is. So we'll talk about renewables. I mentioned renewables, energy efficiency, decarbonization. So the next 20 minutes, we'll go through those three things. Renewables. The one I want to highlight is Section 48, Clean Energy Investment Tax Credit. It's coming up a lot. and I really want to drive home this point, is that exempt orgs are invited to play in the Energy Incentive Program for the first time in legislative history. This is a big deal. Do not assume that your NFPs know about this. Many don't. Many are surprised. Many think, oh no, that goes to my architect. Or they're thinking about local utility rebate programs. That's not this. This is a federal direct pay briefcase of cash to them if they do these incentives. So I really want to drive home. And another slide on this. Again, we're seeing a lot in healthcare. They're always building, renovating something. We're seeing this in education a lot too. A lot of building and renovating in that space. Schools, yes. Senior living, nonprofits. We're even doing presidential libraries. And religious. A lot of churches and schools are getting into the program the more we educate. So those kind of the industries where it's new for them. Now, that's not to take away, if you're a for-profit, anything, you're invited to play. You've always been invited to play. But these two slides are just to make the point that exempt orgs are invited to play now. So what do you have to do to get the credit? We saw in the example in the story, it was a geothermal. These investment tax credits, they've been around for a bit, 70s or 80s, maybe even before. And what Congress does is they attach on things they want to incentivize. Right now it's clean energy. 48 is the one. Solar and wind have been incentivized for a while. We see the windmills going up and solar, this and that. They widened the field goalposts now. Now geothermal's in there. Fuel cells, microturbine, combined heat power, waste energy, energy storage, biogas, microgrid, electrochromic glass. If you are a CPA, you're not expected to know what these are, but at the very least, you should know that they're buzzwords, that they exist, and that if your clients are thinking about doing this, or you should let them to know that these are the things that might get them money. Not just money to pay for it, but money to above and beyond.
Yeah, I would say geothermal is solar's right now the king. That's what we see the most of. Solar drives enormous benefit, somewhat dependent upon where you're located. I would say right now, Arizona, California, New Mexico, those make huge, obvious sense in that space. The other area, once again, a little bit energy location specific, is with the geothermal. Geothermals, the payback on that really is pretty powerful. Same thing for, usually you'll see a microgrid for a large system. Biogas, we see a fair amount of energy storage, obviously batteries. That's another area. But really, what Mark was alluding to there, right, is what is, how has this become economically viable? And the way that it ultimately becomes economically viable is that the payback, right, is historically been 30%. It's generally been 30% for a chunk of this, for like solar, not for everything on this, except the list has been expanded upon. But now, if you can get the payback, 40, 50, 60, 70%, if you thread the needle for this property, the payback becomes substantially lower. I've seen it as low in practice as you will pay it back in 1 year. 1 year after the investment, and then from there, your power is effectively your maintenance costs. That's the way that I would look at it. That's pretty powerful stuff, and it does change economics and decision making.
It's kind of funny. Accounting is moving the needle in green energy. Who would have thought? In the story was an $800,000 upgrade to geothermal. And if our clients were doing DIY, they may apply 6% and get a $48,000 direct pay. They're for profit, they would get a credit, tax credit. Getting into the program, getting an energy incentive consultant involved, one with CPAs and PEs and attorneys. We were able to increase that basis to 3 million and get that percentage up. Name of the game is this: try to make your basis as big as possible and make your percentage as big as possible, then multiply. And how do you get there? Well, really, it's the accounting of it, the functional interdependence test, which we won't go into the weeds, but it's out there. It's been out there for other service lines like cost segregation, soft cost indirect spread, then the bonus percentages, and then there's going to be a registration process. You're going to have to register for this, particularly, I would say, in the direct pay world. So the IRS wants to look out for bad actors. There's a lot of money being thrown around here. We want to make sure it's done right. So you can see how it's powerful. Very basic. Basis plus percentage. Get those numbers as high as possible before filing anything. Here's some best practice tips that we're giving to our clients that should be given, you give to your clients. Work with your designers early to get alternate bids for energy property. And that's exactly what we did with the hospital that went geothermal. They had natural gas. The engineer came back and we asked them, hey, can you, just curious, how much would it be if we switch this to geothermal? And they'll be, okay. And they'll go through, not realizing that, this could be more money for fee increase or scope increases for them. And they went back and gave us the $800K alternate bid. And there you go. I'd also say we're advising this. Work with your facility engineer to incorporate energy property in your capital expenditure request. We have clients, we have a client that has 300 hospitals. They're not-for-profit. The facility engineer has to go through it. This hospital needs a remodel. This needs an ER addition. There's a whole process for that. If you get energy property in there sooner than later and talking with tax and talking with accounting, you can start to capture these things in real time. Remember, we have 10 years. So we can start to make this just a matter of course, but laying the foundation, and that runway is running out, but laying the foundation in 2023 so that for the next 9 years, we're just capturing these things as a matter of rhythm. Okay. Those are some tips. I'm going to go ever so fast through this. The point of this is know the buzzwords. Solar, very popular. I think we all know solar right now. Geothermal, using the Earth's core temperature to heat and cool. It's relatively easy to do if you do it early in the process. So you want to have those conversations sooner than better. When we talk about wind, we're not talking about the windmills. There's incentives for that. That's not what we're talking about. We're talking about things you just throw up on the roof. Capacity of 100 kilowatts. That's where it's at. Fuel cells. I'm seeing this a little bit in California using hydrogen. I don't want to focus on that too much. Combined heat power. Yeah, we're seeing this in manufacturing. If you have manufacturing clients, this could come up quite a bit. Waste energy recovery. We're seeing this. One of our hospital clients is using ice storage for the HVAC system. Again, this is the come together of this. The accountant needs to come together with the facility engineer and leadership to find this stuff out. And in one case we found, yeah, they are doing this. Oh, that's great. It kind of falls under this accounting bucket. Let's go and get that credit. Microgrid controllers, mostly for campuses, either hospital or universities or counties and government counties. All right, this is like a self-sustained electrical system for them. Energy storage. We're seeing more of the batteries, particularly in residential. You put a solar battery that ties into your solar system, array, put into that battery. It's a nice 1-2 to collect that solar power and use it on cars and whatever's in the garages. So really flying through this. Biogas, again, really big in the ag industry. This is more of getting carbon out of decarbonization, a touch as well. Not seeing tons of this. This we are seeing tons of. Let's say solar, big, geothermal, big, and then electrical again. This kind of surprised me, but even Fargo's, our headquarters, iBailey's headquarters in Fargo, we're doing a renovation. We're putting electrical in class, not because of this credit, we'll take it, but we're already putting it in. And we're running into clients, retail clients, office clients that use this glass anyways. You don't need window treatments. It fogs up in the middle. You can see the before and after in this picture here, and it's actually, it works pretty cool. And now there's a credit available for it. We got to let people know about it. Decarbonization. Again, 7 minutes here. The decarbonization primarily, as from a popularity point of view, is around cars. If you have infrastructure like charging stations, and not just the charging station, but the electrical connected to the charging station, the switchgear powering on and off that charging station, there's credits available. Fleets, companies that are getting a lot of vans or cars, or building up their fleet, there's credits available. Then, yes, if you do have clients that are throwing smokestacks in the air from ammonia or cement or ethanol gas, there is a credit there to capture that smoke. It's actually quite cool scientifically, and pumping it thousands of feet into geological formation. And that's out there too. We don't see tons of that, but when we do see that, that shows well. So from a decarbonization point of view, you have 45W, 30C, and O'Neill, you want to take 60 seconds on this one if you're still around?
Yeah, absolutely. I'd say, it's there's some pretty unique areas in this space. And frankly, this is an area of the tax law that I think they did a pretty poor job on. I feel like you should, and businesses should get benefits from EV infrastructures. And that's really kind of it's once again a 6 to 30% credit, kind of using base rules around 48. But it's only for low income and non-urban areas. And so it's really incentivizing folks to build EV infrastructure in areas that historically there's not been much, but it's my humble opinion that we need more EV infrastructure, period, kind of all over the place. But that being said, if you've got clients and they're investing in EV infrastructure kind of throughout the general kind of country, it is something worth investigating. Now, they also define this really loosely for non-urban areas. And so you need to go and look at it on a census by census basis, tract basis, excuse me. And then, for the electric commercial fleet, not seeing really any of that in the for-profit space. Where I'm seeing a lot is in the governmental and not-for-profit space. So, whether it's a city government coming in and saying, okay, we're going to electrify our bus fleet. We are going to I have one where they're looking to electrify their school bus fleet for a school bus system. This does change the economics somewhat. It's $40,000 per vehicle, which does add up. However, these buses are quite expensive. Generally speaking, what I've seen, it's anywhere from a 5 to 15% reduction in overall cost if you go down this path. There are, for non kind of buses, right? It's that typical $7,500 you see probably on the individual side as well. Generally speaking, I think this is a little bit of a miss by this tax bill. It's not quite as lucrative as some of the other provisions. And frankly, this is a space that we need to be investing in if this is going to fully catch on. That all being said, that's what the rules are, and that's kind of what we're seeing.
3 more minutes. We're going to cover energy efficiency in 3 minutes and then hand it over to Shannon. When it comes to energy efficiency, this is the beaver, the one that the architects, engineers, and contractors care about a lot. This is the $200,000 one, if you remember. So, and this is also for your for-profit. So what happened was, it's been around, $1.80 per square foot if you do efficient lighting, HVAC, and envelope. Big change. The bonus deduction, you can get as high as $5.36 per square foot. The rules to qualify for it did not change. They're from the year ASHRAE-90.1 from the year 2007. So we're finding that our clients who are just building to code are qualifying for this. Now there's a 3-year cap. Before it was a lifetime cap. You do it once, boom, you're done. Now it's every 3 years. So if you build a building and then 4 years later you renovate something, you can get the deduction twice, 3 times, 4 times, as many times as you renovate within that time period. And it went 2 ways. Once to private owners. If I own a building and I'm taxable, then I get the deduction. If I was a government entity, I couldn't use the tax deduction, so I would assign it. And now it's not just government entities you can do that. Now hospitals and education, nonprofits, museums, we're doing public museums, they now have the power to hand this out. So I'd say from the nonprofit world, focus on the renewables. That's where the money is for you. But you can allocate these to your architect, these energy efficiency deductions. You can have it both ways. So one more slide. Again, this goes both ways. For-profit get it, and designers for non-for-profit get it. You can look back at the deck. This is really getting into the weeds. But this is the slide I want to leave with, is this. For your architect, engineering, and contractor clients, this is how it works. You need 3 people. They need to be doing some design work for an exempt org. It could be government, now it could be healthcare, education, religious nonprofits. So you need them on board. You need the designer. They need themselves to do the designs. They need a third party by law. And that's where the HOG comes in. That's where I-Bailey comes in, licensed in all 50 states. In other words, your architect, engineering, and contractor clients can't grade the test themselves that they've created. It has to be third party. And so we work with the designer to get the certification fee. The exempt org, at their sole discretion, gives it to the building owner. And that's how it works. So touch complicated, but when it works well. Best practice tip that we're giving to all our architect clients is this. Work with your nonprofit early and often to put the language in the agreement. Say, yes, we will allocate this to you if you meet these specifications. Because otherwise it becomes a first come, first serve. Sometimes the electrical subcontractor will ask for it, sometimes the HVAC. So whoever your client is in the designer list, make sure that they know that they need to ask for it to get their piece of it. Okay. And then we're really getting inside baseball. These are some good takeaway slides. And we could talk about these more. And Joe, any closing thoughts before we hand it off?
Overall, I would just say that, yes, this is an area where if your clients are in real estate, if your clients are in heavy manufacturing, or not-for-profits or governmental areas, these are spaces where maybe historically they haven't been spending a lot of time with these investment tax credit, production tax credit areas. This is an area that's absolutely worth investigation at this point. So we are happy to answer any questions you might have kind of going forward. But this is these are kind of the core areas where I'd focus.
Thanks, Joe. And Shannon, I owe you now 4 minutes because I do want another 60 seconds to drive home this point. We talked about changing behavior. They went from a natural gas to geothermal. That's wonderful. Here's one. Community college placed into service on January 15th, 2023. They were building this before Joe Manchin and Joe Biden even shook hands. They had no idea that this was going to be enacted. But because it was placed in service, doors open, it counts. They did some geothermal energy storage, and they got a $420,000 direct pay. And I think this slide's a little thrown off. The horse got the direct pay, the beaver got the deduction. And so the point here is this. You need to look back at your client's portfolio and ask them the question, Did you put in any renewables? Here's a list of the renewables. Did you do any of this stuff? Because it's very possible you might get rewarded with a credit or direct pay if you did. Otherwise, if we don't tell them and we don't consult and we don't advise them on this during, tax planning season, they might not even think to ask for it or get it. The IRS is never going to tell them, oh, by the way, you get this credit. So that's the lesson there with this case study. Okay. And now Shannon, who leads our international tax for Bailey. It's all yours.
Thanks, Mark. Hi, everyone. It's great to be with you here this afternoon, or yeah, it must be afternoon for most of us. I am my main goal is to just leave you with some ideas, talking points, things to think about when your clients are doing business internationally or crossing borders for whatever reason. And at the end, I'm going to talk to you about some opportunities, just some questions to be asking your clients in terms of what they might be thinking about, sort of those probing questions that, one last question type thing. So we'll just jump right into it because we have a lot to cover. When I'm talking with clients, I oftentimes say, and this is a good way to sort of just bring it all together. We have a triangle of items that we need to cover, and this just helps me remember it when our business clients especially are going international. We have 3 areas that we need to think about. We have the corporate side of things, so that could be corporate or partnership, whatever the case may be. We have the individual tax side of things, and then we have an indirect tax side of things, and that often gets overlooked. And unfortunately, sometimes that's the first place where our clients run into trouble. So I like to make sure that we cover the whole triangle as we're having these discussions. So that's something you're welcome to pilfer and use in your practices as well. So for corporate income tax, we really need to be thinking about when a client asks us about what should we be thinking about when we are doing something different internationally. We need to be thinking about whether they're taxable in the foreign country. So that's sort of the first leg of that or side of that triangle. So when will that activity create taxation in another country? And we generally refer to that as permanent establishment. So I like to say that right ahead of time, because I may use that permanent establishment or PE in our discussion. And then of course it depends on whether we have a treaty or not a treaty. So that's, sometimes my first Google search. Of course the IRS has a nice landing page for our treaties, but oftentimes you can find that pretty quickly and just say, hey, we're going into this country. Okay, do we have a treaty? That always makes a world of difference. And then also one of the main questions is, what activities do you plan on doing outside of the US? Are you just selling? Are you providing some services? Sometimes we have a mixture of both, where we're selling something and then needing to install it or provide training around it. And also, are you using an e-commerce platform? Because that oftentimes can also have an implication on whether they're taxable or not. So in terms of taxation in the US, we look at, whether they're going to be taxable there, but also what does that mean from our US tax perspective? So when we're advising clients, we talk to them about structure. So what are the various structures and how that implicates the US? We talk about transfer pricing. Transfer pricing, we could do a whole webinar on that, but it's basically how are we pricing our intercompany transactions? We have to treat each other even though we're the same company as third parties in transfer pricing. Is their IP being used or transferred offshore? And then of course we talk to them about some of the anti-deferral regimes and how that implicates your US tax base, such as sub-F and GILTI. Just a high level things to think about for individual shareholders. So if we have an individual shareholder, that you're dealing with. We look at, okay, in terms of a structure, if we're gonna have a branch, the current tax is gonna be your individual tax rate, and we can take a foreign tax credit if we're taxable in the foreign jurisdiction. If we set up a corporation, in a treaty jurisdiction, we get qualified dividend rates on distributions, but we also add that second layer of tax. And then we also have to think about GILTI, and there's generally no foreign tax credit on the GILTI, but we can make 962 elections to kind of get there in a roundabout way, but that just complicates things as well. But something we can look at. And then we can also use a hybrid vehicle, so it can look like a corporation in the foreign jurisdiction, but we can treat it as a pass-through in the US, and a lot of times that's necessary. It works well. So another option as well. And then if we have a corporate shareholder, again, this is a C Corp in the US, and they can also do the branch with foreign tax credit, tax at 21% with foreign tax credit. Corporation, so they set up an entity, a CFC, we get the dividend received deduction, we have GILTI and foreign tax credits to deal with, and but we also, if you have some intercompany transactions, could qualify for FDII. So that's the foreign derived intangible income deduction, which is an export tax incentive. In this case, I like to highlight that for GILTI purposes, we have the high tax exception. So a lot of times we can get around GILTI if we're in a higher tax jurisdiction. And then of course we have the hybrid option of, it might look like a corporation in the foreign jurisdiction, but not flow through for US purposes. So in terms of a pass-through structure, this is kind of like the threshold decision, right? Do you want a pass-through structure or do you want a deferral structure? And for a pass-through structure, we can use a hybrid entity, so it can give you some legal protection, or you can be taxable in that foreign jurisdiction, but currently taxable in the US, and then you have a tax credit. So that's oftentimes what we're looking at for individual structures, if we have an individual, a partnership, or an S Corp, etc. And then that's generally preferable in a high tax jurisdiction for individuals. And then of course we have the check the box option, which I mentioned. We can make that election to treat an entity as different from its legal form. And then we also have a deferral structure. And so when we're talking with clients, we're often asking, what are your plans for this business? Is this like something where you want to keep your earnings offshore and reinvest them? We have to think about GILTI, so we can't always get around deferral, and subpart F. We can't always get deferral, but a lot of times we can if you have a high tax jurisdiction. Do you want to keep those profits offshore and defer taxation back in the US? And of course, if you're a US corp, if you have a US corp structure in the here, then you're going to get the dividends received deduction. So that's going to eliminate that taxation on the way back. And then if we have an individual, we don't have a foreign tax credit. I mentioned that before. There is an election to treat yourself as if you were taxed as a corporation and take a foreign tax credit. That's an option as well. So. And then other considerations related to, first one is the LLC. So the US LLC, we oftentimes think, oh, well, we're an LLC. Well, that could mean you're a partnership, or that could mean you're a corporation. That could mean it's disregarded altogether. So in the US, we're super flexible, right? Well, in other jurisdictions, it's almost always treated as a corporation. So we run into hybrid entity rules that might come into play, etc. And I always mention in Canada, just not a good idea to use the LLC because of the treaty issues that develop there. And so if your client's an LLC and you're structuring outside of the US, we need to be thinking about the implications of that. And on the inbound side of things, if you have the opportunity to work with foreign companies that are coming into the US, they almost always it seems choose an LLC when they set up an entity. And oftentimes it's after the fact that we find out they've already set up the entity, and that causes issues as well, because a US LLC is treated as disregarded from its owner. And so the foreign corporation is going to be taxed unless we make that check the box election. So we're oftentimes helping them clean that up. And then US or individuals may often or may consider just inserting a US corp to hold the foreign subsidiaries to take advantage of that dividends received deduction in structures now. In terms of the corporate income tax, the questions that we ask, that we're asked to consider, are what type of entity do you, or that we want to consider, are what type of US entity do you have? That's kind of like the baseline question, because we need to think about the implications of foreign activities from a US perspective as well. What plans do you have to repatriate? What function and risks will be undertaking outside of the US? And will you be using that technology or know-how? And the technology and know-how is important from a number of perspectives. There are some anti-deferral rules that could come into play if you structure things in a certain way. And also there could be things that we need to think about from a transfer pricing perspective, like royalties needed, and the transfer of intangibles outside of the US can cause current taxation as well. So we need to be very careful about that. So this is the second side of the triangle, indirect tax. So I will phrase my indirect tax discussion around VAT. It's value added tax. It's very similar to sales and use tax, but there are other versions of it. Like in Canada, in Australia, we have GST and HST, etc. And the key point here is that it shouldn't be an economic cost for the business. It eventually is supposed to be a cost to the consumer. So whoever the end user of your product or service, they should be really the ones that are bearing the cost, unless you do something incorrectly. Then it becomes a cost to the business, which that's where we want to avoid. And then also one difference between our sales and use tax is that it applies to services. I know some states do have sales and use on services, but that is a difference that clients need to be advised upon as well. And then oftentimes there's an interplay between the customs and duties that are paid as well on the importation of goods. And so that's an area where we have people that we refer to for those types of questions, but they do come up. Okay, so I like to give this example, try to keep it simple in terms of VAT and how it's different from sales and use tax. So from a sales and use tax perspective, oftentimes if it's interbusiness, so it's business to business transactions, the sales and use tax, you can get an exemption certificate and maybe not have to apply it. From a VAT perspective, the VAT is assessed along the supply chain. So in every step, there's the VAT component. So in this example, we have a supplier, a manufacturer, retailer, consumer, and at the very outset, the supplier assesses $200 on whatever they are selling. They assess that VAT on the supplies of $200 and they remit that back to the government. They send an invoice to the manufacturer for $1,200 because the supply was $1,000 in value. Well, when they end up selling it on then to the retailer, they get a credit for that tax, that input VAT that they paid. So you can see at the top, when they sell it to the retailer, they're selling it at $1,500. They assess the VAT at 20% of $300. So they remit the net of that, what they assess versus what they have already paid back to the government of $100. So as you can see, it continues to go along until at the end of the day, we have the consumer paying VAT at the rate of 20% on the goods that they purchased for $1,600. So that's just sort of a basic example of how it plays out in real life. And then when will indirect tax apply? Well, it's generally applicable before corporate income tax. So this is where our clients oftentimes will get in a bit of of a pickle where maybe they have gotten to a place where it is accessible, but they don't necessarily have a tax a structure set up for that, and so that can be difficult. Treaties aren't applicable to VAT, and really a lot of countries are moving to the place of consumption standard. So that means wherever the consumer is, they want to be able to assess. And I think the US is kind of doing the same thing. Since Wayfair, it's basically, you know, if you have a certain threshold of sales in my state, and in this case in my country, we're going to make you assess and remit the VAT. And so one thing that I want to point out is that if you have clients that are selling directly to consumers, this is super important, and they're selling to consumers outside of the US, they likely have a VAT obligation. So that's something that if you're working with some consumer-based businesses, you should be having that conversation with them, whether they're taking care of the VAT. And a lot of them are using like Shopify and systems of that nature, and so they'll be notified already, but it's something to ask if you're in that space. Then we want to talk about individual taxation. So whenever we're doing business cross borders, there's probably going to be an individual involved. And so we ask questions such as, well, what phase is the company in? Do they have a subsidiary or not a subsidiary? Where is the individual tax resident? That's going to be key, important to figuring out what we need to do from a tax perspective. What are the employer obligations? So one thing to keep in mind is if employees are traveling overseas and doing some work, whether they're staying a long time or not, there could be some withholding or reporting obligations of the employer. And they're going to have to be managing multiple, potentially managing tax returns in multiple jurisdictions. And then, although treaties apply oftentimes to mitigate some of those impacts, we also have to be thinking about social taxes, like the Social Security equivalent in other jurisdictions. And then also there are companies that get to a point where they may need a global mobility program. I'm going to talk about that more in depth later, but there we're looking at what policies do you have in place? Is there a PE risk exposure, and also any payroll preferences? So do you want to stay on US payroll, or do you want to be on foreign jurisdiction payroll? How are you getting paid? And all kinds of complications there. So in terms of our global mobility programs, these are companies that have usually multiple individuals that are traveling or have been seconded to maybe a foreign subsidiary. And so the things that they need to be thinking about are, what are the policies related to that? So that's the very basic, like, if somebody goes, what are we going to compensate for? Are we going to compensate for housing? Are we going to provide them a car? Also, do we need to have a secondment agreement in place? And a secondment agreement is often used where we really want to be careful about creating a permanent establishment for the US company that's sending an individual to a foreign subsidiary to work. We also talk to them about tax equalization. And in our world, what we generally see is that US companies are tax equalizing their employees that have been asked to go to a foreign assignment. And one of the main drivers of that is, well, one, they want to get them there. They want to incentivize them to do that. But also the individual tax rates in the US are generally lower than they are in European countries, let's say. And so if they do send them to another jurisdiction, they're ultimately going to pay that higher rate of tax, and that could be a squeeze on the individual. And then with relation to tax legalization, as I mentioned, which payroll do these individuals stay on? That's a big question. And then there's all kinds of nuances related to that, like shadow payroll we can do, where we keep them on one payroll, but we pretend like they're being paid in another in another jurisdiction. So we do all the reporting and withholding, but ultimately they're still staying on the payroll of the home country. And then oftentimes companies are helping or they're actually sometimes even mandating that they use a certain provider to prepare the tax returns in both jurisdictions, especially when tax equalization is happening, because they want to make sure that it's getting done correctly. I want to talk a bit about remote workers, because this is a question that, especially during the pandemic and post-pandemic, has become very popular question about, I have an employee that is originally from the UK and would like to go back home and work from there. And so we get this question a lot of what are the implications of for the company. And I will say that, like, in these one-off situations, the majority of the time our clients decide not to allow it, because of the complications that it implicates. So I'll talk through, kind of what that consultation generally looks like from a client perspective. So, first of all, we have to think about both the company and the individual and what those tax issues are. And from an individual income tax standpoint, one thing that we have to be thinking about is their tax residency. So it could be that an employee wants to go and spend 3 months in Greece and work there for a while. Well, you might just turn your head and pretend you didn't know that, which could have IT implications and all kinds of other things. But the threshold question is that individual going to create tax residency for themselves? And every country has its own sort of rules around what would create tax residency, meaning oftentimes that they're taxed on their worldwide income. What we want to do is avoid being in a situation where we didn't realize, and we end up in a place where we have double taxation. I've seen this happening, especially on the people that are coming into the U.S. coming back into the U.S. to work. So we've had situations where, our engineer decided to come back to the US and work there, and we just kept him on, let's say, UK payroll. Well, you're in a situation where the employee didn't know that, the employee is working in the US, and so it's US source income. And they have been continuing to pay tax in the UK on that income, and it's not creditable because you don't have foreign source income. So unless there's an ability to resource under the treaty, which is a narrow sort of facts and circumstances that could apply, they're in a position where they have to pay tax in the US, and they've already paid tax in the UK, and we have double tax. So maybe there's an ability to go back and amend returns or what have you, but it gets really complicated really fast, and then you have to get the company involved, and it's not very fun. The other thing that we look at too is, when they do create tax residency, or whether they create tax residency also depends upon the tax treaty, if there's one available. So we can spend some time looking at that and helping with that determination. There are lots of other taxes. So this is more, thinking about US individuals going to other countries. Sometimes there's wealth taxes. The social taxes are a big component. So in the US, we have Social Security tax. Many other countries also have similar taxes. If an individual is going to another country for a period of time of 5 years or less, there are some tax agreements that say we can actually keep them on the US Social Security program. That's where that shadow payroll thing happens a lot too. There's a state tax and there's gift tax in each country as well. So we just need to be careful about those items. And then, of course, if an individual is, spending some time in another country, and they are going to be getting on a foreign pension program. They, might need to open a bank account. They might have foreign, well, in terms of, I'm thinking about coming into the US. So people are coming into the US temporarily. They might have some trust that then all of a sudden has some US reporting requirements. And we often see people who are, have some sort of like side business or have an existing ownership in a family business, and then that becomes reportable in the US as well. And then, of course, the global payroll. So one of the biggest roadblocks for companies in whether they're assessing if they will allow an individual to go to another country and work for a while is the payroll tax withholding obligation. So almost in every circumstance that we've looked at, the company then would have an obligation to register for tax ID and to set themselves up to be able to withhold and remit payroll taxes. And if it's a one-off, I want to do this for 6 months or a year type thing, and it's not a key employee, a lot of the time that headache is what really stops the conversation. And then the other thing related to that is that we need to make sure that the employee actually has legal ability to work there. So that's one of the first questions that we ask is when people are coming into the US, oh, okay, well, what kind of visa do you have? And the same on going the opposite direction as well. So just a lot of things for companies to be thinking about. And then for the company itself, they need to be thinking about when will that activity create taxation in another country. So that's that PE question. So is that person like doing something that would trigger a taxable presence in that country? Or let's say we have a treaty, they're doing something that's not really key to the business. So really we're just allowing them to sit there. And that could be a situation where they wouldn't create a taxable presence. But if it's a salesperson or somebody that's key to the business, likely would create a permanent establishment. And that's not the end of the world, but the company will need to assess whether that additional burden of needing to file a tax return and worrying about double taxation, etc., would be worth it. And so we always are needing to know, if this person is going, like what exactly will they be doing there? And sometimes we can manage that, but not always. So we need to be careful there as well. In terms of entity level taxation, I referred to this before, but they're looking at whether from a corporate tax perspective, whether there is sort of nexus. So I like to use that word just to translate it back to like the US concept of nexus. So employees working in a country can create that taxable presence. And of course, income tax, like I mentioned, the income tax treaty can apply. But the one thing to note is that people have a lot of times have in their head this 183-day rule, like, well, I'm not going to be there for 183 days, so I'm not going to be taxable. So there are some nuances to that rule that could trigger them to be taxable. And so we need to be careful about that. And again, that could implicate the company, because then they're required to report or withhold and report wages for the employee. During the pandemic, there were some relaxed rules with respect to remote employees that were announced, but most of them have been, well, I would say likely all of them have been rescinded as of now, because it's not really applicable. So in the non-income tax and other business issues, looking at payroll withholding, whether having that employee there would trigger value added tax obligation. So let's say we have an individual who's a salesperson and they have been calling on, sales and for Canadian companies for a period of time, and they're from Canada, let's say. And so they decide to ask their employer if they can go and work from Canada now, since they're calling on, Canadian customers, etc. Previously, the company wasn't subject to GST in Canada because they didn't have nexus for GST purposes. But having that person there then move to Canada, even maybe temporarily, could trigger them to have that obligation. So that's where we want to be careful. And then other regulatory requirements may apply. So looking at, licensing, entity registration, legal and employment law. I would say the scariest part about having an employee in another country is the employment law implications. So oftentimes we think, oh, well, our employment laws are pretty stringent and strict, but in my experience, in Europe, it's even more so. And so you need to make sure that for instance, do you have an employee handbook, and does it need to be revised so that it covers that person? So you really have to have good advisors with respect to that. And then, just looking at employer individual risks. So that's are you able to retain this employee? Maybe they're that important to you because you are allowing them to to move overseas or be temporarily outside of the US. And then just making sure that they have their immigration straightened out. So having the correct visa or work permit as well. We belong to a network of firms called HLB International, and it really just allows us to serve our clients in whatever country they may be looking at doing business in. And so iBailey has been a part of this network for over 20 years. We're the largest firm in the network, so we have just a lot of experience and depth of relationships in the network. And I like to tell people I came from the Big Four, and of course the Big Four firms have great networks, but I think ours is just as good, if not better, knowing that, it's not the only option. And so we could find services from multiple firms within the network. So in the UK, I believe there are 5 or 6 firms there. In Germany, a very large number. So we really have great connections there. If you ever need a connection in another country, feel free to reach out to me, and I can get you connected with somebody that I likely have a personal relationship with as well. So we're happy to point you in those directions if needed, even if iBailey doesn't need to be involved, and that's perfectly fine too. And then I will leave you with just some opportunities. These are some conversation starters for as you're coming to year end, and companies are oftentimes in budget mode right now, and so they're thinking about what their next steps are. So the first one is, are you exporting? And that also is a good place for us to look at when we're looking at just when we're looking at state nexus. That oftentimes, and we're looking at apportionment on tax returns, so we're often looking at those sales by state spreadsheets, right? And so that information is super helpful to glean whether they actually are importing or exporting. So you may already know just by looking at that. And one thing that I find kind of fun is that they oftentimes show the Canadian provinces as states in their reports. And so you can kind of pick those out. And sometimes people don't think about Canada being another country, but it certainly is. And we can take advantage of some export tax incentives related to exporting. So those being the IC disc and the FDII deduction. So I'm not sure how much experience you have with those, but the IC disc is generally used with a pass-through structure where we actually have to set up a separate entity to take advantage of that. And then the FDII deduction is an export tax incentive that is allowed for only C corporations. And in both cases, it's something that well, and I'm sorry, in the FDII deduction space, you can kind of look back and figure out what that deduction is. On the IC disc space, you do have to have the structure set up before you can take advantage of it. So there's some pre-planning that needs to be done there. And then, of course, with respect to exporting as well, just be mindful that that could bring up some VAT or GST issues, the indirect tax considerations that we talked about. And then, not a bad time to ask, hey, have you thought about expanding, this business that you're doing? Have you thought about taking it to other countries or selling to other countries? And then one thing I always like to note too is some companies have implemented in the last couple of years these like work from anywhere policies. And just to, be mindful if you do know of that, to be mindful that anywhere, probably shouldn't mean anywhere in the world, just because of the issues that we've talked about before here. And then of course, if they have, asking if they have any employees working remotely, and this can bring up state and local tax issues as well as international issues. But again, checking on that work location policy to see if we can reduce some risk for them. So I think we've left some time for questions, and Jim, maybe you have some closing remarks as well.
Yeah, no, thanks, Shannon. Does anybody have any questions or things that are burning, like FDII? That's a new one to me. FDII, that was a new one to me. If not, I guess we'll just wrap up a couple things. Thank you so much to Mark and Joe and Shannon for demonstrating their expertise, giving you all some information to chew on. And as noted earlier, we have a lot of different specialty areas that we're happy to help out you and your clients with. So reach out to any one of us. If you do have a situation where you're unfamiliar or it's just a little bit beyond your comfort level or your experience level, happy to help out.